The stop loss. A simple line on a chart. A number that should shield the trader from disaster. Yet, for the majority, it has become a silent executioner. In the dim glow of pre-market screens, traders sit with an air of confidence. Charts meticulously marked, levels neatly plotted. They whisper to themselves that risk is controlled, that danger is contained. But the truth is far more brutal. The stop loss is only effective when wielded with precision, discipline, and understanding. Misplaced, it does not protect, it destroys. Jesse Livermore, one of history's greatest speculators, understood this distinction with unmatched clarity. He saw the difference between discipline and fear, between patience and reaction, and most importantly, he saw the market for what it truly is, a living organism that reacts to human behavior, not to logic or fairness. The first mistake is placing a stop loss where everyone else does. It is human nature to seek order, to anchor exits to obvious support and resistance levels, to follow patterns that appear safe. A line drawn under a recent low, a protective shield just below an apparent trend. It feels rational. But the market is ruthless. It hunts predictability. When thousands of traders anchor their exits to the same price, the market gathers liquidity. Those stop orders become a target, a magnet for movement. Price does not move randomly. It moves to fulfill the demand and supply embedded within human decisions. Being at a common level is a death sentence for your stop. You are not unlucky. You are visible. Livermore's genius lay in his patience and observation. He did not trade from the obvious. He waited for the market to reveal its intentions. He watched how price interacted with critical levels, analyzing volume, momentum, and the subtle ebb and flow of buying and selling pressure. Only when the movement confirmed his understanding did he commit. His stop loss was not a comfort blanket. It was a declaration: if I am wrong, I exit, and I live to fight another day. That is the difference. The market does not care about convenience, sentiment, or hope. It only reacts to order flow. A stop, placed at a logically looking level, without context, is a premature surrender to randomness. Observe the chaos that unfolds when traders cluster their stops. A minor shake, a testing candle, and suddenly, panic cascades. The stop triggers. Traders exit. Volume spikes. The market moves against them, then reverses with merciless irony. This is the market's invisible hand at work, and it has no conscience. The crowd suffers because they mistook logic for edge, convenience for insight. To survive, one must learn to read the rhythm of the market, not its apparent symmetry. One must resist the psychological lure of safe stop placements. Liquidity hides in plain sight, and the market will always seek it. The second dimension of this first error is the emotional tie traders form with their stops. Many treat them as shields of safety, as protection against Yet, a stop is not a promise. It is a test. Will you allow yourself to be proven wrong? Will you trust your analysis enough to let it breathe? Most cannot. The fear of loss lurks in the mind, whispering doubt, urging premature exits. And when the stop is triggered by mere market noise, the trader reacts with frustration, blaming luck or circumstance. Livermore saw this before anyone else. He recognized that temporary setbacks are part of the process, part of the natural oscillation of a living market. To panic at the first minor deviation is to surrender before the battle even begins. He also understood the importance of context. A stop must be rooted not in static levels, but in the behavior of the market itself. Volume volatility, market structure, and trend alignment. These factors influence where a stop should reside. The goal is not to avoid loss entirely, that is impossible. The goal is to make the loss manageable and inconsequential, while allowing room for the trade to develop. Too tight, and normal fluctuation triggers it. Too obvious, and it becomes a target. The right placement balances risk with opportunity, discipline with insight. Finally, the broader lesson of the first mistake is humility. Markets are not obedient. They do not honor lines drawn with hope. They are indifferent to human psychology, except insofar as human behavior creates patterns. Recognizing this requires a blend of observation, patience, and emotional control. Livermore mastered these because he refused to surrender to conventional wisdom. He refused to be trapped by his own desire for predictability. To trade like Livermore is to accept uncertainty while acting decisively. To respect the market while imposing your reasoned judgment. This is the foundation of profitable stop-loss strategy. Awareness of the market's invisibility, respect for its liquidity, and the courage to set stops where the market validates, not where fear dictates. The second stop-loss mistake is born not from logic, but from fear, the subtle, creeping terror of loss that infiltrates every trader's mind. You enter a position with conviction. Charts align. Indicators support your thesis. Everything points toward opportunity. Yet, as the market moves slightly against you, doubt seeps in. A minor pullback becomes a signal of impending disaster. The heartbeat quickens. Hands tighten around the mouse, and suddenly, the stop-loss is moved closer, tightened, adjusted to protect capital. It feels responsible. It feels prudent. But in truth, it is the first step toward self-destruction. Jesse Livermore recognized this weakness, not as a moral failing, but as a psychological inevitability. The human mind is designed to avoid pain, to recoil from discomfort. Markets exploit this instinct. The small, temporary loss triggers panic, while the large, sustained profit requires patience, endurance, and courage. Most traders fail this test before the first meaningful move develops. Tightening a stop in response to a minor adverse movement is a reaction to emotion, not an adjustment to reality. Market fluctuations are not anomalies. They are the natural rhythm of trading instruments. Price oscillates, volume surges and ebbs. Every tick is a probe, a test of who is committed and who is afraid. The impatient hand is shaken out first, leaving only the disciplined, the patient, the observer. This is how markets redistribute wealth from the fearful to the steadfast. To survive, a trader must understand that a stop-loss is not a shield against normal volatility, is a tool to manage genuine evidence-based invalidation of a trade thesis. It is a boundary, not a reactionary leash. Those who mistake a minor fluctuation for a signal of catastrophic loss are destined to watch opportunity slip away. Over and over again. Consider Livermore's approach. He never allowed a single tick to dictate the positioning of his risk parameters. Instead, he measured stops against market structure, volatility, and position sizing. The goal was never to avoid loss entirely, which is impossible. The goal was to make losses small, manageable, and part of the broader equation of trading. When he entered a position, he accounted for the natural ebb and flow of price. He allowed room for the market to breathe. He recognized that short-term turbulence is the signature of a healthy market, and that reacting impulsively is the quickest path to ruin. This level of discipline requires emotional mastery. Most traders never reach it. They are prisoners of the moment, slaves to their own adrenaline, victims of their inability to sit still while uncertainty unfolds. The consequences of tightening stops are profound. Each premature exit chips away at both capital and confidence. The trader begins to second-guess every decision. Wins are diminished by impatience. Losses are amplified by fear. Patterns of behavior become entrenched. A once rational approach is replaced by reaction, a continuous cycle of frustration and missed opportunity. It is an erosion of potential that often goes unnoticed until it is too late. The disciplined hand, on the other hand, endures. It observes the shakeouts, learns from the probes, and positions itself to capitalize on the movements that the fearful cannot endure. In this contrast lies the difference between mediocrity and mastery. The psychological underpinning of this mistake is profound. Fear of loss is stronger than desire for gain in the human brain. It is hardwired. Livermore understood that no strategy could survive without controlling this internal adversary. The market does not forgive emotional trading. A tightened stop is a confession of weakness, a signal that the trader is trading feelings rather than analysis. One must cultivate a mindset in which small losses are accepted as the cost of learning, as a natural toll of participating in the market's movement. In doing so, a trader converts fear from a paralyzing force into a tool for measured judgment. Discipline transforms the emotional reaction into strategic advantage. Furthermore, position sizing is inseparable from stop management. Fear manifests most aggressively when a trader's exposure is too large relative to their tolerance for fluctuation. The solution is not to manipulate stops to suit emotion, but to reduce size so that market noise does not provoke panic. Livermore risked less to think more clearly. He never tightened a stop simply because the heart demanded comfort. Instead, he allowed positions to play out within the boundaries defined by analysis. This separation of capital and emotion is one of the defining principles of successful trading psychology. It allows the market to reveal itself, rather than forcing it to conform to human impatience. It is the difference between reaction and calculation, chaos and control. Every trader faces this test countless times. Every slight retracement presents the temptation to shrink stops, to chase comfort, to avoid small losses. Most succumb, and the cumulative effect is catastrophic. Yet those who resist the ones who measure risk, accept fluctuation, and respect the market's natural movement accumulate advantage. Patience becomes profit. Discipline compounds over time. Losses remain manageable. The small controlled setbacks allow the profitable positions to develop into significant gains. Livermore's brilliance was that he recognized this dynamic, embraced it, and lived by it. He understood that trading is not about avoiding discomfort, but enduring it strategically. The market does not move to accommodate fear, it punishes it. Those who internalize this truth learn to let positions breathe, to respect volatility, and to master themselves before attempting to master the market. The second stop-loss mistake is a mirror. Reflecting the trader's internal weakness, tightened out of fear, repositioned impulsively, and dictated by emotion, it erodes both capital and confidence. To overcome it requires courage, patience, and a clear understanding of market behavior. Stop losses are not punishments, they are tools. Mismanaged, they become chains. Managed correctly, they allow the trader to survive the turbulent noise of the market long enough to capture the meaningful trends. This lesson is as vital today as it was in Livermore's time. It is the difference between fleeting survival and enduring success. The third stop-loss mistake is the most insidious, the one that masquerades as hope but delivers destruction. Moving a stop further away after entering a trade feels harmless at first. Just a little more room, the mind whispers. It will recover. It's just a fluctuation. The trend is still intact, but this is not prudence. It is negotiation with reality. And the market does not negotiate. It is indifferent to human wishes, immune to hope, and relentless in its testing of those who fail to respect its rules. Jesse Livermore called hope and fear the twin enemies of every speculator. They lure the trader into overconfidence, indecision, and ultimately, ruin. Adjusting a stop to avoid taking a loss is an admission that fear has overtaken discipline. That judgment has been replaced by desire. That logic has surrendered to ego. Every trade begins with defined risk number that represents the maximum acceptable loss based on analysis, market behavior, and position sizing. That number is sacred. It is the price of information, the cost of testing a hypothesis against reality. When price reaches this point, the market has delivered its verdict. It says, your timing is wrong. Your premise is flawed. Exit. To resist this verdict by moving the stop is to reject reality. One loss becomes many. Small damage multiplies into catastrophic erosion. Livermore experienced this firsthand, losing vast sums when he allowed hope to override discipline. But he survived, learned, and rebuilt because he respected the stop-loss as a tool of survival, not a measure of pride. Every successful trader learns this lesson. The market cannot be bargained with. But survival can be ensured by respecting its boundaries. This mistake is reinforced by human psychology. Loss aversion dominates cognition. Traders are wired to avoid realizing a loss. It feels final, a personal failure. Yet failure is not in the loss, is in refusing to accept it. Every extended stop creates larger exposure, magnifies risk, and compounds the potential for ruin. In contrast, a disciplined stop-loss contains damage, preserves capital, and allows opportunity to be seized elsewhere. Livermore often said, "Cut your losses quickly and let your profits run." This statement is deceptively simple, but its implementation requires mastery over ego and emotion. Moving stops out of fear or hope is the opposite of this principle. It turns a tool of survival into an instrument of self-sabotage. Moreover, moving a stop after entering a trade undermines every other rule of sound speculation. It destroys risk-reward balance, inflates exposure, and erodes confidence. When a trader repeatedly does this, pattern recognition, and instinct, two of the most critical tools for successful trading, become unreliable. The mind becomes conditioned to ignore market signals, to rationalize failure, and to postpone the inevitable. Over time, this behavior accumulates losses that dwarf potential gains. Livermore observed this in countless contemporaries who were talented in analysis but weak in execution. They could see trends, understand cycles, and predict movements. Yet their inability to respect stops ensured they never achieved consistency. Discipline, not intelligence, is the rarest edge in the markets. The correct approach is rooted in predefined invalidation. Before entering a trade, one must know the exact conditions under which the position is wrong. This is not guesswork. It is analysis based on market structure, volatility, and behavioral cues. Once those conditions are violated, the stop-loss serves its purpose. It exits the position and preserves the ability to trade another day. Accepting losses as part of the cost of doing business is vital. It is not a concession of defeat, it is the currency of survival. Livermore cut losses decisively, understanding that one uncontrolled loss could erase months of careful speculation. He let the market deliver its verdict and moved on, always prepared for the next opportunity. This philosophy separates the disciplined trader from the emotional one, the survivor from the casualty. Profits in the market are asymmetrical. Small, controlled losses are the price of the large, sustained gains. One cannot experience growth without first enduring setbacks that are properly managed. When traders move their stops in response to fear, they invert this asymmetry. Minor setbacks become catastrophic, while potential gains are truncated by impatience. Livermore's principle is clear: respect your boundaries, accept the loss, and remain disciplined. In doing so, the trader ensures survival, preserves capital, and positions themselves to capture the market's generous but fleeting opportunities. This is the core of trading wisdom that has survived decades of market evolution. Ultimately, the third mistake, moving stops to avoid losses, a test of character. It forces a confrontation with ego, patience, and the harsh realities of speculation. The market will not accommodate your wishful thinking. It will test, shake, and punish those who surrender discipline for hope. Survival, the prerequisite for profit, demands adherence to predefined risk parameters. A stop-loss is not a convenience. It is a declaration of respect for the market, a safeguard for the future, and a mechanism to ensure continued participation. Traders who master this principle internalize the rarest edge, thinking correctly under pressure, acting decisively in the face of uncertainty, and letting reality dictate outcomes rather than emotion. In the end, it is not the market that destroys traders, it is their own inability to honor the rules, to cut losses swiftly, and to let profits breathe. By avoiding the three fatal stop-loss mistakes, placing stops where crowds gather, tightening them out of fear, and moving them to avoid loss, a trader begins to think and act like Jesse Livermore, positioning themselves not merely to survive, but to thrive in the relentless arena of speculation.